So that's now how the theory was simplified, but we shall be explaining it further, how the theory was meant to be used to determine the optimal capital structure. So now we can add there a paragraph by noting that according to this theory, comma, the cost of equity is affected. The cost of equity is affected by both the financial risk and the business risk. The cost of equity is affected by both financial risk and the business risk. Both the financial risk and the business risk. Then you continue by writing that as leverage increases, the equity shareholders would demand a higher return. The equity shareholders would demand a higher return. They will demand a higher return in order to be compensated. Would demand a higher return in order to be compensated. For the increased financial risk. In order to be compensated for the increased financial risk. Then another paragraph we write that since the equity shareholders are well compensated, for the increased financial risk. They are well compensated for the increased financial risk. Their perception about the company will not change. Their perception about the company will not change. Leading to the conclusion that the capital structure is irrelevant. Therefore, there is a contradiction between net income theory and net operating income theory. There is a contradiction between net income theory and net operating income theory. This conflict was resolved by Franco and Miller. So it was resolved by Franco Modigliani. And Martin Miller. It was resolved by Franco Modigliani and Martin Miller. In their proposition, known as MM proposition. in their proposition known as MM proposition. So that is simply Modigliani and Miller. So that is now the MM proposition. So this is now an improvement theory to now reduce the conflict between the two. So we can now have a subtopic as MM proposition. We can now have a brief subtopic as MM proposition. We can now have something about MM proposition. MM proposition. We can now have the MM proposition. So under MM proposition, we summarize that MM in their first proposition, MM in their first proposition, MM in their first proposition, they dealt with the value of the company. They dealt with the value of the company. They dealt with the value of the company. And they concluded that, there are no two identical companies. They concluded that there are no two identical companies. There are no two identical companies which can attract different values. There are no two identical companies which can attract different values, simply because one company is levered, and the other company is unlevered. Simply because one company is levered and the other company is unlevered. Simply because one company is levered and the other company is unlevered. Then another paragraph, we write that MM argued that if the two companies attract different values, MM argued that if the two companies attract different values, then the investor will practice. Arbitrage process. The investor will practice the arbitrage process in order to restore the value of the two companies to equilibrium. In order to restore the values of the two companies to equilibrium. In order to restore the values of the two companies to equilibrium. Then another paragraph, we write that arbitrage process operates under the following assumptions. The arbitrage process operates under the following assumptions. The arbitrage process operates under the following assumptions. Number one is that there is a perfect and efficient capital market. Number one is that there is perfect and efficient capital market. There is perfect and efficient capital market. Number two is that both companies and individuals can borrow or lend out. They can borrow or lend out. They can borrow or lend out any amount of money. They can borrow or lend out any amount of money, at the risk-free rate. They can borrow or lend out any amount of money at the risk-free rate. Then another paragraph, we summarize that under this assumption, Under these assumptions, comma, the arbitrage process operates as follows. Under these assumptions, comma, the arbitrage process operates as follows. The arbitrage process operates as follows. So step number one is that the investor will sell his ownership. The investor will sell his ownership in the overvalued firm. The investor will sell his ownership in the overvalued firm and realize the amount. Will sell his ownership in the overvalued firm and realize the amount. So he will sell, the investor will sell his ownership in the overvalued firm and realize the amount. The number two is that the investor will then borrow. The investor will then borrow on the personal account. The investor will then borrow on the personal account. On the personal account, the amount equivalent to his percentage of ownership. An amount equivalent to his percentage of ownership. His percentage of ownership multiplied by his percentage of ownership multiplied by the amount of the debts, in the company's capital structure, multiplied by amount of the debts in the company's capital structure, The number three is that the investor will then make comparison. The investor will then make comparison. He will then make comparison between the proposed income from the new company, and his current income, in the current company, Then number four is that the investor will then invest in the company. The investor will then invest in the company where his returns are maximum. The investor will then invest in the company where his returns are maximum. He will then invest in the company where his returns are maximum. So we shall use a question to see how to practice the arbitrage process to restore the values of the two companies to equilibrium. So the question we are going to apply will be November 2017. Question number 4, part B. November 2017. Question number 4, part B. November 2017. Question number 4, part B. So we check November 2017. Question number 4, part B. So we check November 2017. Question number 4, part B. November 2017. Question number 4, part B. So the question reads that the following data relate to two companies. Alpha Limited and Beta Limited, which belong to the same risk class, which belongs to the same risk class. Then they have given you number of the ordinary shares outstanding for Alpha Limited and also for Beta Limited. They gave you market price per share, also 6% debentures, market value. They only gave you for Alpha, Beta it is a dash. Profit before interest and tax has also been provided. The profit before interest and tax has also been given. So you can see they are the same for both companies. That's why the two companies belong to the same risk class, because their income is the same. So we normally say that when the income of the two companies are the same, their value is supposed to be the same according to M and M. So their value is supposed to be the same because they are in the same risk class. But now we shall discover that one company will be having a higher value than the other firm. That's why we need now to practice the arbitrage process to determine how to make the returns to be equal. So all the profits after debenture interest are distributed as dividends. So now required, using suitable calculation, determine how under Modigliani and Miller approach, but now without taxes. An investor holding 10% of Alpha Limited shares will be better off switching his holding to Beta Limited. Then Roma letter 2, explain when, according to Modigliani and Miller, without the taxes, the process described in B above will come to an end. So we want to see how to practice the arbitrage process. So the first thing we do is to get the value of the two firms. So we had said that under the capital structure theories, there were only two component sources of finance, equity and debt. Equity and debt. So to get the value for the firm, so value of the firm will be equal to value of equity, then we add value of the debt, like that. So according to the capital structure theories, there are only two components, equity and debt. So to get the value for the firm, we simply add value for equity plus the value for the debt. So let us get the value of the two firms. Let us now get the value of the two firms. So we have Alpha Limited, and also there is Beta Limited, like that. There is Alpha Limited and also Beta Limited. So we start with value of equity. We start off with value of equity. So value of equity, you simply take the number of the ordinary shares multiplied by the current market price per share. Alpha, there are 90 million ordinary shares. Market price per share has been given as how much? 18. So multiplied by 18 shillings so that we get value for equity. So that we get the value for equity. We get 1620. Then beta, we also do the same. 150,000 millions multiplied by 10. So that should be able to give us, so we get 1,500 millions. Then we also add value of the debts. We also add value of the debts. So debt was given, but it was only given for which firm? for alpha. So the debt has been given the market value. So this one is 60 millions. The other one was not provided, it is not there. So we add them together now to get the value of the farm. We add them together to get the value of the farm. So we add them together to get the value of the farm. So alpha has which value? So this other one is, so you can see according to M and M, the two farms are supposed to have the same value because they are in the same risk class. Their income is the same. But when you compute their value, it is actually different. The reason is that alpha is levered, beta is unlevered. So this one, you can see it is meant to be levered. It has both equity and debt. This one is levered farm. It has both equity and debt. This other one is unlevered. It is unlevered farm because it has only equity. So now, before we practice the arbitrage process, we also need to compute the cost of equity for each farm. We need to calculate the cost of equity for each farm. So we start with cost of equity for alpha. Cost of equity for alpha limited. For alpha. So we calculate the cost of equity for alpha limited. So because it is levered, the cost of equity is KEL. When the farm is levered, the cost of equity is KEL, which is supposed to be given by earnings before interest and tax. You subtract interest, 1 minus the tax rate. You divide by value of equity. Value of equity. Then we show it as a percentage. So earnings before interest and tax has been given. You can see profit before interest and tax. Both of them, they are how much? So it will be 18 millions. We subtract interest. So interest, you can see 6%. Yes. So 6% of 60 million should give us which figure? 6% of 60 million would be 3.6 million. 3.6. So they said without the taxes. So the tax is not there. They had explained up there that using under required, that using the suitable calculation demonstrate how under Modigliani and Miller approach, but without the tax. So value for equity is what you have there as 1620. Value for equity is 1620 million. So you also express it as a percentage. So the value for equity, you already have it there as 1620 million. So you express that item as a percentage. So you are getting 0.8. 0.88 recurring. Yeah. One tutahitaji hiyo figure utatumia the exact. Yes. When we practice arbitrage process, it must balance. Sasa wakati tutahitaji hiyo figure, we'll go back and get it, the real one. Yes. Yeah, you may not write it now, but when we require it to multiply by something else, you will go back and get it, the exact one. Because we need to practice arbitrage process to balance the returns. If you round off, it will not balance. Because you want to show that moving from one company to another company does not increase your wealth. It will just remain the same. So that is now for alpha. We also compute the cost of equity for beta limited. Cost of equity. Cost of equity of beta limited. So beta limited is unlevered. Beta limited is unlevered. So to get the cost of equity, so KEU will be the cost of equity of the unlevered firm. So remember, it will also be given by earnings before interest and tax. 1 minus the tax rate. We divide by value of equity. And we express it as a percentage. So we already know that earnings before interest and tax is 18 millions for each. There was no tax. Value for equity is 1,500 millions. Then you also express it as a percentage. You also express it as a percentage. So, so that one has given us what percent? 1.2%. So now after that, we practice the arbitrage process. Let us now practice the arbitrage process. So we shall now be required to practice the arbitrage process. So we start off with the step number 1. We start off with the step number 1. So to come up with the arbitrage process, so the arbitrage process. So our step number 1 our step number 1, we shall write that the investor will sell his percentage of ownership. The investor will sell his percentage of ownership. He will sell his percentage of ownership in the overvalued firm. He will sell his percentage of ownership in the overvalued firm, and realize amount, equal to, and realize the amount equal to, So amount to be realized. So that amount to be realized, you can see on what percent in that required Roman letter 1. Under required Roman letter 1, we earn which percent? 10%. So he is in Alpha Limited. Alpha Limited is the one which is overvalued. So you get 10%. 10% of the value of equity. We own equity, we don't own the company. The company has debt, isn't it? So we only own equity. So it will be 10% of the value of equity for Alpha Limited. So 10% of 1620. It will be 10% of the 1620. So it will be 10% of 1620, which is supposed to give us which value? So we get 162. That's now the step number 1. Then step number 2, we write that he will then borrow amount equivalent to his percentage of ownership. Multiplied by amount of debts. In the capital structure. Multiplied by amount of debts in the capital structure. So amount to be borrowed would simply be 10% of the value for the debt. Consider that is how much? 60 million. So you get 10% of 60 million. We get 10%, which is going to be 6 million. So you add there a dash that therefore total amount available for investment. Therefore, total amount available for the investment. Total amount available for investment will be 162 millions plus 6 millions. 162 millions plus the 6 millions. So you add step 1 and step 2. So that will be now our step number 2. Then now we got the step number 3. That the investor will then invest. We got the step number 3. So we can write the step number 3 that the investor will then invest. The investor will then invest in the undervalued firm as follows. Will then invest in the undervalued firm as follows. He will then invest in the undervalued firm as follows. So this now the step number 3. whereby you want to invest. So when you are investing, we start with the amount available. We start with amount available. So amount available for investment. Amount available for investment. We have said is how much? 168 millions. Then we less amount to invest. We less amount to invest. So when he is going to invest, he should maintain his percentage of ownership. When he will go to invest, he must maintain his percentage of ownership. So we know he owns what percent? 10%. 10%. So he's going to invest in Beta Limited. So amount to invest will be 10% of the value of equity for Beta Limited, which is how much? 1,500 million. Because he must retain his percentage of ownership in the new firm. So when he do that, we get 10% of 1,500 millions, which is going to give us 100, so 150 million. So now we can have the balance. We can now have the balance, which must be how much? Must be 18 million. So that's now our step number 3. Then we got the step number 4 by writing that. The investor will then compare his returns in the two companies as follows. The investor will then compare his returns in the two companies as follows. The investor will then compare his returns in the two companies as follows. So we want to show that whether you move from overvalued to undervalued, your returns will not change, will remain the same. That's according to Modigliani and Miller. So when we compare the returns, we want now to compare the returns. We want now to compare the returns for the two firms. So when we are comparing, there is Alpha Limited. There is Alpha Limited and also Beta Limited. So the returns is simply the return on equity. The return is simply the return on equity. So we start by calculating returns on equity. We start by calculating the returns on equity. So Alpha Limited, you can see the step number 1. The step number 1, how much was the value of his equity that he sold? Nakumbuka the step 1, where he sold his percentage of ownership, isn't it? Yes. So that value was 162. Yeah, so we want to know what is the return on that equity. This was his value of equity in Alpha Limited, 10% of that equity. So we calculated cost of equity. That's the return on equity. Remember the figure I said you don't round off. Yeah, can you retrieve that figure and multiply by, I know it was 0.88 recurring percent. So retrieve the exact value, then multiply by 162 million, because now it will have no decimal point. So it will not have that recurring item. It will not be having any recurring item. So just retrieve the exact value on your calculator, multiplied by 162 million, and see it will give you which figure. It is a percentage. Hii kitu multiply na nini? 5%. So divide by 100 to get it in shillings. It was 1.44 millions. So we are getting 1.44 millions. So I hope online all of you are getting the same figure. Are you all getting 1.44 millions? Yeah. So I hope everyone can see where we are getting the 1.44 millions. So after that, we also go to Beta Limited. What should be the return in equity for Beta Limited? So for Beta Limited, I would like you to check the step number 2. You can see your step number 2. So step number 3, the amount invested. Remember the amount invested? Yes. 150 million. So we take 150 millions. You remember KEU, the cost of equity, it was what percent? 1.2 multiplied by 1.2%. Multiplied by 1.2%. So we get 1.8 millions. Then, because there was an item that was borrowed, we less interest. Yes. 1.6. 1.8. So we also get that we less the interest. We minus interest. When he was in alpha, he had not borrowed. He only borrowed when he was moving where? To beta. So there would be no interest there. So I would like you to check in the step number 2 how much was borrowed when he was moving. Sorry? 6 million. The amount he borrowed was? It was 6 million. Yes. Then you remember the interest rate. Interest rate was what percent on the debentures? So get 6% of the amount that was borrowed in the step number 2. 0.36. So we subtract that interest so that we get the net returns. Net returns. So this one would be 1.44 millions. So the other one would be which figure? 1.44 millions. So we are simply confirming the argument by M and M that whether the company is overvalued or undervalued, when you buy there your shares, your net returns will not change. It will be the same. Your net returns will be the same. So whether you buy shares in Safaricom, whether you buy shares in Kenya Breweries, your returns will be the same. Yeah. The same. What is the share? What is the share price of Safaricom? One share for Safaricom is how much? It's around 35. It's around 35. You can assume it's 35, isn't it? One share of Kenya Breweries is around how much? You are not members. You are members, but don't remember the price of the share. We only know the price of the bottle, isn't it? Yes. So it should be around 200. It should be around 200 or so. It should be around that price. So one share there, you are buying it at around 200 shares. So there is no difference, my friend. Hapo utanunua shares ngapi? Moja na 200. Na hapo utanunua ngapi? Yes. But now the proportion will not change. So dividend per share, here labda iko 5. Na hii per share maybe it is 1.5. But here you have 5 shares na hapo kuna share moja. So finally total dividend from each farm is the same. So there is no difference. Yeah. There is no difference per unit. Return per unit will be the same. Because you are buying 1 share in Kenya Breweries, but you buy how many shares in Safaricom? Around 5 shares, isn't it? Yeah. But now finally, what is the effect? Yeah. Overall return will not, because they are all regulated by the stock exchange market. So don't be affected by buying shares in small companies, as long as it is stable and it will remain there and it is paying dividend. And it is paying dividends. So moving from one company to another company, because of the prestige of the other company, does not guarantee you more returns. Returns will be the same, as long as the company is regulated by the security exchange market, because the share price will be high. The other one, the share price will be low. But now you will buy how many shares on the overvalued company? Then also the undervalued company. So finally, the net returns, M and M said that it will not be different. So that's now the argument they are bringing across. So you can buy shares in Safaricom. Thank you. Yeah, you can buy shares in any company as long as the company is stable, yeah, and is able to pay dividends. So finally, you will get the same returns because you will put there 1 million, maybe someone there put there 500,000. But if you get per unit, the returns are the same. So that's now the argument by Modigliani and Miller, where they were saying that there is no need that when I see the share of Safaricom is performing well, you have seen the share price, isn't it? How do we normally assess the performance? Yeah, so you just look at the share price. So you look at the share price, it has gone up. You think it is more profitable. Then you sell your shares in a small company, you go and buy from the other company. So finally, you will buy less shares. But if you go from the dividend perspective, you won't do that. If you go from the dividend perspective, how does it work with that? Because finally, the net returns will be. But now that one does not work because we are not the same. You may be having 5 million, yes, 10 millions. So we look at per unit, the return per unit. Then that unit should be determined by the amount you have put there. The amount you have put on the investment. Because you may put there 10 million, but you get a return of, let's say, 3 millions. Someone has put 5 millions, but gets a return of 1.5 millions. So proportionate is just the same, going by what you have invested. Proportionate return will just be the same. So that's now the argument by Modigliani and Miller, where they said that if you have identified a given company and the company is stable, it has a good going concern. Even if the share price is lower, don't bother. Because some companies, they lower the share price to attract people to buy. Because I won't go and buy a share at 200. It is too expensive. If you have only 100 shares and you want to invest. So you are locked out in this one. So just go there, buy how many shares? 3 or 2. Then you are okay. So this one is to lock out people of the lower income. But even if they are only having the higher income group, their net return is the same as the person in the lower farm. So that's normally the difference. But the issue is not about the performance. The issue is the net return to you as an investor. That's why buy shares of a lower value. If the share is 10 shillings, go and buy. Because when it drops, it can only drop to 8, 5. But this one, if it drops to 100, it has gone a half. You see the net loss you incur. Yeah, so go and buy the shares which are of lower price. Even if it drops, the margin is smaller. But this big one, if it makes a mistake, it reduces by just 10% because it is proportionate. So 10% decrease in this one is too high compared to a 10% decrease in the other farm. Then they may appreciate. They may appreciate. This one, appreciating to go to 400 is very difficult. But if a farm has increased up to 50. See, when they bought those shares, they were at 5 shillings. But now they are around 35. Now this one have stayed there for almost even 30 years. It just fluctuates around that element. So we can now finally get the arbitrage gain. Let us now get the arbitrage gain. We can now get the arbitrage gain. So we can now come up with the arbitrage gain. We can now get the arbitrage gain. So it will be given by net income from the new farm, net income from the new farm, you minus the net income from the current farm, net income from the current farm. So the new farm, when you are looking for the arbitrage gain, assume he invested the full amount because you will do nothing with the balance. Just buy all the shares so that you get the arbitrage gain. So it will be 168 million. You remember the return on equity was 1.2%? Yes. In the new farm. So multiply by 1.2%. But you remember the interest. Interest was 0.1. Interest, you don't calculate two sides there. It was 0.36 million. Yeah, so you subtract the 0.36 million so that you get the net income for the new farm. Then this other one, it will not change, it's just 1.44. Remember the 1.44 million, the net income for beta. So for the new farm, we are saying that we don't want to be left with 18 million balance. So just use the whole amount. If I use the whole amount, I will use 168. So you take 168 million. The cost of equity KEU was 1.2%. Then you subtract, that interest is not affected. It was 0.36 million. So that we get now the arbitrage gain, assuming you spent the full amount. Assuming you spent the full amount. So it will be 0.26. So finally you'll get 216. So it is 0.216. Yeah, so that now will be your arbitrage gain. That will be finally your, because it is 0.216. So when we now factor it in terms of millions, we shall now come up with 116. So that research was done by those two people, and they were even advising people about the companies you work at. So don't be focusing on the name of the company or how popular the company is. Sema mimi lazima nifanye kazi Safaricom ndio nikuwe rich. It is not that way. That's the advice they give people. As long as you get a good return in terms of your salary. There are those other benefits, but those benefits, they may not go up to the end because they were giving some risks in the employment. I'd rather be paid more today rather than being paid less, but I'm looking for the terminal benefit. And sometimes it may not come. Those terminal benefits, for them, it was the advice they were giving people about investment. Buy shares in the low valued companies. Then also when you are employed, don't just focus on these high prestigious companies. Don't just focus, just look at your salary. Is it enough? Because some people are working in Safaricom, maybe they are earning 50. Some other people, they are working in other small companies, they are earning even 150,000. So what is the correlation? So for them, they look at what you are going to get from that company. Because you may look at your terminal benefit. Currently, the employers, they give you a contract. At the expiry of your contract, there is no those benefits you'll be getting from there. So even if they give you a contract, let them give you a good money. Because finally, I know there is no benefit. So because there is no point, even if you are given medical cover, how many of you use that medical cover? To what extent? They may give even 3 million, but the year will end, you have not even spent even 50,000. Yeah, so don't look at that medical cover. Yeah, you have given enough money to pay. Yeah. That's the advice M&M were giving investors. If you are an investor, look for the shortest opportunity possible to make money and go and invest. Then you move out of that particular practice. So at the end of it all, those terminal benefits, they don't count. So you have retired at the age of 60. You won't enjoy that money. I know it will go to your siblings, but you as an individual, what have you gained from that money? Then finally, they may not invest the way you have wished it to be invested. Because most of them, they may not have that knowledge the way you have. You see, the way you have earned that money in a hard way, spending will be different. But for them, it is just there. They don't know how it gets. So finally, the spending item, part of it may not work. But if you have little money, you educate them. Find out after they will make use of it. But if you give them, they may not know the value on how to get that item. So it is good to educate your child rather than leaving them with wealth. Because it may go in one day. Wealth may go away in one day. But your knowledge Europe at a stay. Yeah. Leave them with wealth together with knowledge. If you have it, first of all, make sure that they have knowledge. You are here. So akikataa kwenda shule, piga aende shule. Yeah, my firstborn now, my lastborn. Because the final item, by the way, the research by those guys were done basically on the advice. So that's now where we lie from. So we can now finish the last part of the question where they were saying that explain when, according to Modigliani and Miller, without the taxes, the process described in the above will come to an end. So it will come to an end at the point of equilibrium. You have seen there is no need of you moving out because the return were the same. So we can now summarize that the process will come to an end. The process will come to an end at the point of equilibrium. The process will come to an end at the point of equilibrium. At the point of equilibrium, where the returns of the two companies, will be the same. Where the returns of the two companies will be the same. Where the returns of the two companies will be the same. So let us now have a brief subtopic as MM proposition we can have a subtopic as proposition of incorporating the corporate tax. 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 So under that, we shall first note that when incorporated the corporate tax, when incorporated the corporate tax, when incorporated the corporate tax, they argued that the levered firm, will enjoy. They argued that the levered firm will enjoy the interest tax benefit. The levered firm will enjoy the interest tax benefit. The interest tax benefit equal to interest expenses, equal to the interest expenses multiplied by the tax rate, equal to the interest expenses multiplied by the tax rate, multiplied by the tax rate. Therefore, they argued that the value of the firm, the value of the firm will be affected. The value of the firm will be affected with the increase in the leverage. The value of the firm will be affected with the increase in the leverage. With the increase in the leverage. And another paragraph, we note that the cost of equity for the levered firm, the cost of equity of the levered firm, the cost of equity of the levered firm, given the cost of equity of unlevered firm, given the cost of equity of unlevered firm, will be expressed as follows. Given the cost of equity of unlevered firm will be expressed as follows. Given the cost of equity of the unlevered firm will be expressed as follows. So from the diagram we had drawn before, KEL will be given by KEU plus in brackets KEU minus KG, then D over E, then 1 minus the tax rate. So that formula is coming from the diagram we have drawn under the net operating income theory. So when you want to calculate KEL, simply take KEU plus in brackets KEU minus KG, the proportion for the debt over equity, then 1 minus the tax rate. But you can still get it using the other formula we have used in the previous question, but we shall apply both of them to see how they work. Then another paragraph, we write that when incorporated the taxes, when incorporated the taxes, when incorporated the taxes, they concluded that in order to avoid investors from practicing the arbitrage process, they concluded that in order to avoid investors from practicing the arbitrage process, in order to avoid investors from practicing the arbitrage process, comma, the difference in value of the two companies, the difference in value of the two companies, the difference in values of the two companies will be equal to present value of the interest tax benefit will be equal to present value of the interest tax benefit will be equal to present value of the interest tax benefit. Present value of the interest tax benefit. So this is the argument by M and M. So M and M was able to say that. So M and M was able to say that value of the Lippert farm, value of the Lippert farm will be equal to value of an Lippert farm. Then we add present value interest tax benefit. So to get the value for the Lippert farm, it is simply equal to value for an Lippert farm. Then we add present value for the interest tax benefit. This one is the present value for the interest tax benefit. Then, if you want to get the interest tax benefit, you simply take the interest expenses, multiplied by the tax rate. Just take interest expenses multiplied by the tax rate. Then, to get the interest expenses, simply take the debt multiplied by the interest rate. When you want to get the interest expenses, you simply take the debt, what are the interest rate? So interest rate is the same as KD, like that. Then multiplied by the tax rate, like that. Then now to compute the present value of the interest tax benefit. So to get the present value of the interest tax benefit will be the same as present value of the annuity at R% up to infinity. The present value for the annuity at R% up to infinity. So that one is not in the table. So it is just annuity divided by R. It is just annuity. So to get the present value for the interest tax benefit will be the same as present value for the annuity at R% up to the benefit. So this annuity is your interest tax benefit. This annuity will be my interest tax benefit. So our annuity is this item here, the debt multiplied by KD and multiplied by the tax rate, like that. So this R is the cost of capital. R is the cost of capital, and it's the cost of the debt, and it's the cost of the debt. Cost of the debt is still KD. Cost of the debt is still KD. So finally, this item and that item would cancel off. So when you will be calculating the present value interest tax benefit, simply take the debt multiplied by the tax rate. The debt multiplied by the tax rate. So finally, when we shall be calculating our present value for the interest tax benefit, simply take the debt multiplied by what? The tax rate. So that's now a summary of what we should be able to use. So we can pick a question from your past papers, November 2016, question number 3, part B. We can check November 2016, question number 3, part B. 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 So that question 3, part B for November 2016. The one for Manchu Limited is just about to commence operation as an international trading company. So the firm will have a book value of assets of 320 million, and the tax, so they expect 16% return on these assets before interest and tax, which means our earnings before interest and tax, we shall simply be taking 16% of 320 million. Then also, however, because of certain tax arrangements with the foreign government, the company will not pay any taxes. Then it is known that the capitalization rate for an all equity firm in this business is what percent? 12%. That's now our KEU. It is known that capitalization rate of an all equity what? Firm. So that is the cost of equity for an levered firm. They were able to give you 12%. So the company can borrow debt finance at a rate of 7% per annum. At a rate of 7% per annum. So the management is in the process of deciding how to raise the required 10 million debt finance. Assume that Modigliani and the Miller assumption will apply. So now required using the MM model without what? Taxes. They would like you to determine Roman letter 1. Current value of the unlevered farm. Roman letter 2, current value of the levered farm. If it uses how much? 10 million, 7% debt. Roman letter 3, WSCC of the levered farm at a debt level of 7% shillings, 10 million. That's now part B. When it comes to part C, they were also explaining that assuming that the company in part B above now pays taxes at a rate of 30%. At a rate of that, compute the following in the Modigliani and the Miller. Compute the following in the Modigliani and the Miller world. Roman letter 1, the current value of the firm if it uses no debt. That is unlevered. Roman letter 2, current value of the firm if it uses debt level of 7% shillings, how much? 10 million. And finally, Roman letter 3, the WSCC. That's now when they restart. So the difference between part B and part C is just the tax. Part B, they are saying without taxes. Then part C, now there is tax. So we start with part B. Roman letter 1, current value for the unlevered firm. So we start off with the Roman letter 1. How to get the value for the unlevered firm. How to calculate the value of the unlevered firm. So to compute the value for the unlevered firm, what we need to do first, let us first compute the earnings before interest and the tax. We shall first calculate from the first paragraph. Earnings before interest and tax will be 16% of 320 million. Will be 16% of 320 million. So what will be 16% of 320 million? 51.2 minutes. 51.2. So now we go to the Roman letter 1. We now go to the Roman letter 1. So Roman letter 1 is made to be the value of the unlevered firm. Value of unlevered firm. Value of the unlevered firm. So to calculate the value for unlevered firm is the same as market value of equity market value of equity. Market value for equity, which is the same as earnings before interest and tax, 1 minus the tax rate, divided by KEU. You remember the formula of KEU? You make now value for equity to be the subject. When the firm is unlevered, there is no debt. When the firm is unlevered, it has no debt. So the value for that firm will be the same as market value for equity. Remember beta limited. We only multiply the number of the shares by the market price per share to get the 1,500 millions. So when the firm is unlevered, its value is the same as value for equity. So we have just calculated our earnings before interest and tax. You have given me 51.2, but they say without the tax. So KEU is given in the first paragraph as 12%. You can see the 12%. Yes. So divide by 0.12, like that. We divide by 0.12. Divide by 0.12. So it should give us how much? 426.67. So that is now your Roman letter 1. So let us now go to Roman letter 2. Roman letter 2 is the current value for the levered firm. So Roman letter 2, we get the value for the levered firm. Value of levered firm. So Roman letter 2, we compute the value for the levered firm. So value of the levered firm, from the formula I've just given you, it is value of unlevered, then present value interest tax benefit. When you want to get the value for the levered firm, it is simply value for the unlevered, then we add present value interest tax benefit. So value for unlevered, we have seen it is 426.67 million. Then you recall how I said you have to compute the present value for the interest tax benefit. It is the debt multiplied by the tax rate. But that Roman letter 2, the debt is how much? When you check in the question, it has, it is 10 million shillings. So you take the 10 million shillings, but they said the corporate tax is what? It is 0. They say without the taxes. But B is without taxes. But C is the one with the tax. So when there is no tax, the value of the two firms will be the same. When there will be no tax, the value for the two firms will be the same. That was the argument between Modigliani and Miller. It's the difference between levered and unlevered is the present value interest tax benefit. But now if there is no tax, that benefit is not there. So that value will just remain 262.67 million. That's now our Roman letter 2. At the moment there is no tax, the value for the two firms will be the same. Then we go to the Roman letter 3, WSC. You want now to calculate the WSC. We compute the WSC of the levered firm. WSC for the levered firm. Want now to see how to calculate WSC. So WSC, to calculate the WSC, we simply get the weight of equity, cost of equity for the levered firm, weight of the debt. So KD must always be after the tax. KD must always be after the tax. So in the process, because we should get the weights. To get the weights, you say that value of equity, value of the firm, not equity, value of the firm is supposed to be given by value of equity, then we add value of. So to get the value for the firm, it is value of equity plus the value for the debt. So they are asking for the Lifford firm. Lifford firm, we have gotten 426 points. So this part is 426. 467. So equity should be the market value, but the debt should be the book value. So not the value for the debt. It is 10. So what should be now the value for equity? What should be now the value for equity? For it to be 426.67. So it should be which year? 416.67. So now we calculate KEL. So the reason why we have done that is to get the proportions. You see, to get the weight for equity, we'll take this divided by this. To get the weight for the debt is this divided by the total. So that's now the proportions. Then another item we should calculate is KEL. So I've given you two formulas which will confirm both, whether they will give you the same. So today I've said that KEL will also be given by KEU plus in brackets KEU minus KG D over E. Then so I've also given you that formula today. So to compute our KEN. So KEU, you already know from the first paragraph. It was what percent? Nakumbuka 12. So remember the 12%? Yeah. KEU was 12%. Then when we calculated the Roman letter 1, we divided by KE. It was 12%. So this one is also 12%. So KG is the interest rate on the debt. You can see the 7% here. Yeah, so it is 7. So D is this value for the debt. That particular D is the value for the debt. E is the value for equity. So you get the 10 millions divided by 416.67. So they say there is no tax. The tax rate is 0. So let us compute that figure. Get 12 point. Others are getting 12.12. 12.12. Online, I also, they say they're also getting 12.12. Or alternatively, I had also given you another formula of how to get the same. So KEL will also be given by earnings before interest and tax. We subtract interest. Then 1 minus the tax rate divided by value of equity. So our earnings before interest and tax, remember it was 51.2. It was 51.2 millions. 51.2 million. So we are supposed to less interest. We know that debt is 10 million. Yes. Interest rate is 7%. Interest rate is 7%. What is 7% of 10 millions to give us the value for the interest? 0.7 millions. So you get 0.7 millions, 0.7, then there was no tax. Then value for equity is 416.67 million. So get that figure. It must be the same as what you have just calculated. So just So you are getting the same thing. Yes. So you just pick one of the formula for the exam purpose. They will give you the same. So now we can compute our WSC. We can now calculate our WSC. Now be able to calculate WSC. So to get the WSC, so weight for equity, take 416.67 millions, divide by 426.67. So you say it is 12.12 KEL. 12.12, then we add. So the proportion for the debt, it will be 10 millions. So we divide by the total, which is 426. So it's 7. So KD, remember the 7%. So there was no tax. So there is no need of factoring that Roman letter 1. Part B was without the tax. So when there is no tax, WSCC is the same as KEU. When there is no tax, but WSCC is the same as KEU. When there is no tax, WSCC is the same as KEU. You already have KEU. You are only confirming that. We'll finally get the I'm going to get 11 points. So finally it will be 12. The reason is we have rounded off something there. When there is no tax, the WSCC of the levered and the unlevered is the same. So for unlevered, WSCC is the same as KEU. So there is no debt. WSCC will be 12. So now when there is no tax, WSCC for the unlevered and for the levered will be the same. So together part B, mtaona the difference because part B now will have the tax. Because we shall be repeating the same, but now we can put the tax. So finally it will be 12%. Finally 12%. We are getting 11.12. We are getting 12. So now we can proceed to part C. We can now go to part C. So part C, they were explaining that, assuming that the company in part B above, now it pays what? Taxes at a rate of 30%. Compute the following in the Modigliani and Miller world. Roman letter 1, current value of the farm if it uses no debt. That means it is unlevered. Roman letter 2, current value for the farm if it uses debt level of 7%, shillings 10 million. Now it is levered. Also calculate WSCC at 7% debt level of 10 million. So we are repeating the same, but now we factor in the tax. Everything will remain, but now we factor in the taxes. So everything will remain, but now we factor in the taxes. So we start with the Roman letter 1, value of the unlevered farm. So Roman letter 1 is value of unlevered farm. Value of the unlevered farm. So remember, it was earnings before interest and tax. 1 minus the tax rate divided by KEU. So remember, earnings before interest and tax. Because with what? 1. Then 1. So now the corporate tax rate is 30. So KEU, remember 12%. So you divide by 0.1. We are getting 298. Yeah. 298.67 minutes. So that will be your Roman letter 1. So now we go to the Roman letter 2. Now we go to the Roman letter 2. So Roman letter 2 will be now value of levered farm. So when the farm is levered, value for the levered farm will be value for unlevered and present value interest tax benefit. So you simply take what you have already calculated, which is 298. 298.67. Then we add. So remember now it is the debt more for the tax rate. So debt is 10 million, corporate tax is 30%, the same as 0.3. So 301.67. So that is now our Roman letter 2. Now we go to the Roman letter 3. So Roman letter 3 is the WSEC, which will be the weight of equity, cost of equity for the levered, weight for the debt, KD, which must always be after the tax. So first we say that value of the farm should be equal to value of equity, add value of the debt. So we know the value for the farm is 301. 301.67. So we say equity must be the market value, but the debt is how much? 10 million. The debt is 10 million. So what should be the value for equity? So 291.67. So 291.67. So after that, you compute KEL. So I've said you just apply one of the formula. So that second one is normally more accurate. So you just apply one of the formula. So we apply the second one, whereby KEL can be given by earnings before interest and tax. You subtract interest, then 1 minus the tax rate. We divide by value of equity, and we express it as percentage. So earnings before interest and tax was with here, 1.2. Then interest, so remember 7% of 10 million. You are 0.7. Then 1 minus 0.3. So value for equity is 291.6. Then expressed as a percentage. Nothing. 12.12. So now after that, you can get your WMCC. So our WMCC, the WS, so the weight for equity, it is 291.67 divided by 301.67. Multiplied by 12.12, then also 10 millions divided by 301.67. So KD, remember it was 7%. Also multiplied by 0.7. 1 minus 0.3 is 0.7. Because it's after the tax. 1 minus 0.3 is the same as 0.7. So now WSC will reduce. When you use more debt in the capital structure and there is tax, WSC will reduce. It has gone down to what percent? 11.7. 11.7. 11.88. Yeah. So WSCC will always reduce when there is more debt, but the value for the farm will always go up. The value for the farm will always go up. So they did not ask for any advice, but I want us to check one last question where there is advice, where you can advise. So let us check the one for May 2018, question number 4, part B. We now check May 2018, question number 4, part B. May 2018. Question number 4, part B. May 2018. Question number 4, part B. Check May 2018, question 4, part B. So you can see the question for Lenga Limited. Question 4, part B, where they said that you can see the unlevered farm, May 2018, question number 4, part B. May 2018, question 4, part B. You can see the unlevered farm operates in the textile industry. The one that operates in the textile industry. Yes. It is on which page? 40. Others 45, others 40. Yeah. So you can confirm on the basis of that. So they have said that the firm's current capital structure is summarized as follows. So they gave you ordinary share capital, shillings 50 per value. Share premium is given, then retained earnings, and also shareholders' funds. Total has been given as 240 million. So the firm is considering borrowing 10% debt finance of shillings 40 million in order to finance an expansion program, making it what? Levered. So when you borrow, the firm becomes levered. Then they continued to say that additional information, note number 1, annual earnings before interest and tax generated by the firm are 60 million. This is expected to remain constant each year in perpetuity. Number 2, the firm's ordinary shares are currently trading at the market price per share of how much? 200 shillings at the securities exchange. Then the corporate tax rate applicable is what percent? 30%. So required using Modigliani and the Miller approach and the information provided above. Analyze the financial implication of the change in the capital structure. So changing simply means moving from unlevered to levered. So what do you do? You start with when it is unlevered. Calculate the value, calculate the WSC. Also go to when it is levered. Calculate the value and also the WSC. That will give you the implication. Because we said that optimal capital structure will be where value will be maximum, WSC will be what? Minimum. So when you are answering that question, always split it into 2. Start with when it is unlevered. And then calculate the 2 items, the value and WSC. Also go to when it is what? Levered. Also calculate value and WSC. That should be the order. That should be the order. So we start with when the firm is unlevered. So we start off with when the firm is unlevered. When the firm is unlevered. When the firm is unlevered. So when the farm is unlevered, we start the unlevered farm. Unlevered farm. So when it is unlevered, we want to compute the value. So first, value of unlevered farm. Value of the unlevered farm. So value for the unlevered. Remember, we said it is the same as market value of equity. Market value of equity. So for this question, I cannot use the formula of earnings before interest and tax. 1 minus the tax divided by the value for equity. So the KEU, isn't it? So the question has not given you KEU. But there is no cost of equity for the unlevered farm. So we cannot apply this formula. You see this formula, value for the unlevered is earnings before interest and tax, 1 minus the tax rate. We divide by what? Okay. Remember what we have done in the previous question. But this one is not given. So for that purpose, just get the number of the ordinary shares. Number of the ordinary shares multiplied by the current market price per share. Current market price per share. So if you don't have this information, especially when there is no KEU, it means that to get the value for unlevered, simply take the number of the ordinary shares multiplied by the current market price per share. So number of the ordinary shares, you can see the ordinary share capital. There is 120 millions. The bar value is how much? 50 shillings. Then you can see down there they gave us in the note number. In the note number 2, market price per share is how much? So multiplied by 200. Get that value. Sorry? 480. So that is now our value for unlevered farm. So now the next item, we compute the cost of equity for the unlevered farm. So we shall also be required to calculate cost of equity of unlevered farm. Cost of equity for the unlevered farm. So that is the same as KEU. So it is earnings before interest and tax, 1 minus the corporate tax, divided by the value of equity, then express it as a percentage. So earnings before interest and tax was given. In the note number 1, we have been given how much? So we take the 60 millions. Corporate tax is 30%. Value for equity is what you have just calculated up there. When the farm is unlevered, the value for the farm is the same as the value for equity. So you divide by 480 millions, then you express it as a percentage. 8.75. So Roman letter 3, we need to calculate the WSCC. So WSCC is the same as KE. When the farm is unlevered, there is no debt. So WSCC will be the same as your KE. It is already 8.75. When there is no debt, our KEU will be the same as the WSCC. So that is now when the farm is unlevered. So now we convert into levered. Let us now check when it is levered. So we convert to the levered farm. Now convert to the levered farm. Now convert to the levered. So when the farm is levered, now convert to the levered farm. Levered farm. So you always start with the value of the always start off with value of the farm. We always start off with value for the farm. So value for the unlevered farm will be equal to the value for the unlevered farm, then present value interest tax benefit. Value for unlevered is on how much? It was 480 million. So now they are borrowing how much? That is delivered. So it will be 40 millions multiplied by the corporate tax. It's 30%. So it will give us 492. So after that, we should calculate the cost of equity of the levered farm. Cost of equity of the levered farm. So when it gets to that point, first you say that value of the farm will be equal to value of equity. Value of equity, we add value of the debt. Value of debt. So we know the value for the farm is 492 million. So value for equity, I say it must be the market value. But the value for the debt will not be how much? 40 million. So that one should give us it here. 452. So now you compute KEL. It is supposed to be given by earnings before interest and tax. Subtract interest, 1 minus the tax rate, value of equity, and you express it as a percentage. So earnings before interest and tax. You can see the figure in the first paragraph in the note number 1. So you are given 60 millions. So interest, we simply take 10% of 40 million. You see where the 40 million was? Yes. Now the farm is considering borrowing 10% debt finance or 40 million. So 10% of 40 million should be 4. So you subtract 4 millions. 1 minus 0.3. So value for equity, it is 452. So express it as a percent. So once you are finished, now you go to the WSC. So after that, we now also compute what is supposed to be the WSC. Now also calculate the WSC. So WSC the weight of equity, cost of equity for the delivered farm. Which must always. So, weight for equity is 452 millions. Divided by the total, which was 492. So what were you getting as KPF? What cost of equity for the delivered farm, the matter which percent? 8.67. Now that would be 40 millions, also divided by 492 millions. So KD is the interest rate. You can see 10%. So you apply 10%, also multiply 0.7. That is 1 minus 0.3. So that now will give you the WSEC. So that now should be able to give you the WSEC. So it will give you the WSEC. So we use that to advise in the Roman letter 2. We shall be applying that to advise the Roman letter 2. So Roman letter 2, they were asking that, justifying your answer, advise the management on whether to change its capital structure. I want you to advise whether to change the capital structure. So we only use 2 items, the value and the WSEC. So check before the value. You can see before the value and after the value has gone up. You see before, that is unlevered. When the farm is unlevered, the value is lower than when it is levered. Then also check the WSEC. When it is levered, WSEC is higher than when it is levered. When it is unlevered, WSEC is higher than when it is levered. So you can see that element. And then we had said that optimal capital structure is where value is maximum, but WSEC is minimum. So you are advised to change because it has led to increase in value, but a decrease in WSEC. Yes, you can see those differences. We just use 2 items. First, the value, then WSEC. We had explained that optimal capital structure is where the value is maximum, but WSEC is what? Minimum. So we can now advise that it should change the capital structure. It should change the capital structure. It should change the capital structure as it will lead to increase in the value. It will lead to increase in the value, but a decrease in the WSEC. It will lead to increase in the value, but a decrease in the WSEC. It leads to increase in value, but a decrease in the WSEC. So that's now how you are to advise on that element. So we shall stop there. When we meet, I will do one more question before we conclude on that. So let us stop there today.